Hey, Landon, have you ever been on a webinar before?
Nope, this is my first one.
Wow, are you nervous at all?
A little bit, yeah.
Well, just if you get confused, just spin your head around and that distracts them a lot. Like that. Oh, that'll be the secret thing if you just spin your head around. What's your educational plan, Landon?
I'm going to Emory Law School in the fall.
Wow. Well, how did you choose Emory?
Uh, a lot of research, definitely. A lot of research.
I was created on an Emory board. All right, we're going to start the presentation now, and it only gets worse. Thank you. Okay, here we are. It is Saturday, May 17th. I'm Alan Gassman. I have Brandon Ketchrin, Landon Brewster, and Peter Farrell, and we're going to take you through likely tax law changes. Brandon, do you want to briefly explain where we are in the legislative process of making the sausage?
Yeah, so from what I last looked at it, and I confess I didn't check any updates if there's been anything to happen this morning, but we had a pretty lengthy proposal that came out towards the beginning of the week and a nice summary that was released. And the kind of consensus was that all Republicans were in agreement and this was kind of going to get pushed through. There was a little holdup yesterday, though. They went to the budget committee and it failed in the budget committee vote by a vote of 11 to 16. So now it's a little bit back to the drawing board. I think a lot of the discussion is around the SALT limitation and some New York and California congressmen wanting that to be increased or modified. But I think we have a pretty good idea of where we're heading. And this, presentation will cover that aspect of it. But there may be some minor changes to this. And of course, all of these are proposed. We may end up with something completely different, but just reading into the tea leaves a little bit today.
Well, you know what the goal is for the tax reduction of each area. You wouldn't expect that it'll get any better when they say they want the estate tax exemption to go up to 15 million, when they want the Section 199A deduction for qualified business income to go up to 23%. I don't think it's going to get better than that, but it's probably not going to get that much worse than that. So I feel that we can cover what they've proposed with about a 90% certainty that the vast majority of these items are going to be covered. And that's what we're going to do today. Please note the presentation does not qualify for continuing education credit. If you want a certificate of attendance, we can go ahead and send that to you. Or we can send you the box top from a Kellogg's cereal box if you prefer. Just let us know an address. If you want to ask a question, we'll pretend to know the answer. Just click on question, type in your question. First type in, this is a fantastic webinar. I'm really enjoying it. My question is, and then put in the question, and Peter will answer the question, or if Peter doesn't know the answer, then Landon will make up an answer, which is important in law school, Landon. If the professor calls on you, you know that, right? If you don't know the answer, make one up and assert it with great confidence. Upcoming events, a lot of stuff coming up. Did you know that May 29th is 529 plan day? And Kevin Miller and I have a lot of information on 529 plans that a lot of people don't know about. Later on, I'll be showing you our Estate View estate planning software. Thanks to Jerry Hess, John Blotmacher, and Bob Keebler for helping us out with this. We can give you a free trial if you attended today. Would love to do that. Okay, now onward we go. Brandon, I'll let you lead the way here.
Yeah, so what I've done is I've taken a lot of the bill proposals and tried to summarize these down into a sentence or two. So we have some more detail on a lot of these items later on in the slides. But for now, we'll just kind of cover, what I kind of pulled out as the key highlights. There's much more to the bill. It's 389 pages, so this certainly isn't everything. But it is a good portion of it that I think will impact the majority of the taxpayers that are going to be impacted here. So number one, I think off the bat, a lot of these things just extend the 2017 Tax Cuts and Jobs Act provisions. The first one, the highest marginal tax rate is going to remain at 37%. We have the rate brackets later in the slides, and I think that is going to be around 711,000, if my memory serves correctly, for married filing jointly taxpayers to get to the highest rate bracket. So we're just continuing inflation increases from this year and kind of staying status quo with respect to rate brackets. The standard exemption increase that happened in 2017, that now becomes permanent. It no longer sunsets. And then on top of that, we get another temporary increase of $2,000 for married taxpayers, $1,000 for single taxpayers, that goes through 2028. So we're looking at a $32,000 standard deduction. So even less people are going to be itemizing deductions, giving this nice increase for the standard deduction. The simplification of the tax return with the elimination of personal exemptions, that now becomes permanent. A lot of that's impacted in the standard exemption increase. So we no longer have those personal exemptions that apply. The child tax credit now becomes permanent at $2,000, and we get a $500 increase. So it might go to $2,500 through 2028. That does begin to phase out at certain levels of income. 400,000 of AGI, and for married taxpayers, 200,000 for single taxpayers. A nice one for a lot of businesses that are taxed as partnerships or S corporations is our Section 199A deduction. The QBI, or qualified business income deduction, becomes permanent. It no longer will sunset, and it's actually going to increase to 23% of qualified business income instead of the 20% that we currently have now. Now, there are some modifications to the calculations for 199A that Peter's going to walk through with us later on in the slides that may not make it as powerful as it once was if you have high income, but still a 23% deduction, and that will be a nice benefit for a lot of taxpayers. Moving forward, number 6, for us estate planners, good welcome news. The estate tax exemption is going to remain in place, and the estate tax not going to be eliminated. But the good news for taxpayers is that we get an increase to $15 million for the exemption amount. So that's pretty much status quo, I think. I think that's probably where we would have ended up, pretty close to that anyway with inflation adjustments. So, this year we're at 13.9 million exemption amount. Next year with inflations, we might have been pretty close to 15 anyway. So that's what it's going to be permanently. It's no longer subject to a sunset provision. But, as you know, tides change. So a different administration comes into place. We could see this actually reduced with future tax bills. And Alan's going to touch a little bit on that with in some future slides. The alternative minimum tax, or AMT, changes that happened in 2017 remain into place. So no longer sunsetting those additional phase out thresholds and your AMT exemption increase. One negative aspect of this is the 2017 change to the interest deduction on qualified residents remains in place. It used to be $1 million, and they reduced that to $750,000. That's going to stay in effect and no longer sunset. And then the non-deductibility of interest on home equity indebtedness also stays into effect. So you can only deduct up to $750,000 of acquisition indebtedness or interest on that debt, not $750,000, but the interest on $750,000 of debt. Personal casualty losses, again, a negative extension is that the losses have to exceed 10% of your AGI before they can come into account. So if you have, say, $500,000 of AGI, your losses have to exceed $50,000 before you can start counting them. So if you had $60,000 of losses from, one of the hurricanes, you can take into account $10,000 of those losses if your AGI is $500,000. Lower income taxpayers, if it's $100,000, your losses have to exceed $10,000. Another negative extension is the extension and now made permanent is the elimination of your miscellaneous itemized deductions. So only those things that are specifically listed, generally state and local taxes, interest, charitable contributions, medical expenses, those are still deductible. But your miscellaneous deductions like investment expenses or legal fees or Expenses incurred for managing a business, for example, those are, no longer deductible. Miscellaneous itemized deductions are eliminated. So a lot of these, investment management fees that are charged each year, those fall under the miscellaneous itemized deductions. Those are not going to be deductible moving forward. We also have the reinstatement of, similar to the P's limitation, if you're familiar with that terminology that applied, where you have a limitation on your amount of itemized deductions that you can take for high income taxpayers. And this is a permanent provision as well, or a proposed permanent provision, is worded in a very strange way in the tax code. They actually refer to it as a 2/37 reduction. They could have just said 5.4%. That would have been much easier to understand. I did the math for everyone there. But essentially, it's up to a 5.4% reduction if your income exceeds the highest rate bracket. So high income taxpayers might have their itemized deductions limited by 5.4% of those deductions. So you can take into account what is 94.6% of your deductions. So not a huge deal, but it is a slight revenue gain for the service there. Number 12, Trump promised this in his campaign speeches, and this is the provision that brings it into effect, is the no tax on tips. And it actually is taking the form of an above the line deduction. And it only counts if those tips are reported on a W-2 or 1099 or a Form 317 that's filed by the taxpayer. So if you accept cash tips and don't report those, you should report them in income. They're only reported if they're only deductible if they're on a W-2. And that's going to require us now to separately state those items on a W-2. Same thing for the overtime provision, and we'll get to that. This is scheduled to sunset in 2028, so a 3-year provision of no tax on tips. Number 13, overtime. No tax on overtime is also implemented with an above the line deduction. Again, separately stated now on a W-2, so we can take this into account, and this sunsets in 28. Landon's going to give us some more detail on the no tax on tips and overtime here in a few minutes.
But let's just mention that all of these are proposed. None of these laws have passed. So when Brandon says this happened, it means we expect these things to happen, but there's going to definitely be some changes to them. And
thanks for making that clear, Alan.
And any of you clients could send your tips to 1245 Court Street, Suite 102, Clearwater, Florida 33756, and we'll send you a self-addressed envelope for that if you need it. Just let us know.
Yeah, I think we might include a line on our invoices now of tips optional.
Right. Service and beauty. Well, we are beauties, so I think
we enhance the beauty of our clients. That's for sure. Moving along now, number 14, the provision includes an increase in the standard deduction for seniors. So if you're over the age of 65, you get an additional $4,000 deduction or exemption for your standard exemption. So if you're married and over the age of 65, it goes from $32,000 to $36,000. Let's get back forward here. That does begin to phase out at $150,000 if your income exceeds that for married filing joint taxpayers, and sunsets in 2029. Here's another a new proposal is a deduction for interest on qualified passenger vehicles up to $10,000. So if you finance your car and you have AGI under $100,000, you can deduct that interest that you pay on the car as an above the line deduction. And by above the line deduction, I mean it's not an itemized deduction. So you would get this without regard to whether you itemize or take the standard deduction. So a nice provision there for qualified passenger vehicle loan interest. Another interesting one, and this might apply for a lot of our clients that are interested in supporting these types of things, is a new tax credit for contributions to scholarship granting organizations up to $5,000 or 10% of your adjusted gross income through 2029. So if you have AGI of $1 million, you can give $100,000 to a scholarship granting organization. And I'll go through in some future slides about what that is, but it's basically organizations that give scholarships to primary and middle school, high school scholarships for education, for private tuition or otherwise. And you get that as a tax credit on your income tax return.
Wow. So you
So
basically
that's
direct the government to make that payment. That's fantastic.
that's right. Yep.
Really good.
That goes through 2029. So we'll see where that one ends up. This is one that was in place during, I think COVID is when they put these provisions in place where you got a small above the line deduction for charitable contributions. This is, I think it was $600 at one point that you could deduct maybe in 2020 and 21. That's going to be $300 and goes through 2028 tax year. So, not a huge benefit, but hey, it's something. If you tithe and give donations to a church, or give money to the school your child attends, you can take $300 of that regardless of whether you itemize or take the standard deduction. Number 18, this is an interesting one, a money account for growth and advancement, or termed a MAGA account, is going to be basically a tax deferred vehicle where you can put up to $5,000 per year for a child. You basically set up a trust. If they're under the age of 8, you can start this account. If they're over the age of 8, it's not qualified. You have to be under the age of 8 for this to start. And then you can put up to $5,000 per year into that account until they reach the age of 18. And then when it comes out of the account, if it's used for the right things, such as education, post-secondary credentialing expenses, so like any trade certifications or licensings you could use it for. If you start a small business and take out a small business loan, you can repay the loan with these amounts, and you can use it towards the purchase of a first-time home. That's capital gain. So your gain, you still get your basis in the contract, so you're not basically converting it all to gain like you would with an IRA. You have your basis, and any gain would be a capital gain, regardless of what the underlying character of the gain is. If you use it for non-qualified expenses, it's taxed as ordinary income and a 10% excise tax. And if there's anything left in the account at age 31, it all comes out to the beneficiary, included in income as capital gains. But tax deferred vehicle, and I ran some quick numbers. Other thing I should mention, this is an interesting part of it. If you have a child born after 24 and then before 2029, the United States is actually going to put $1,000 into this MAGA account for each child, unless you elect out of it. So you can set this up for your child and the US will fund into that account. Or if you don't set one up, they set one up for you and put it into the account. So I did quick math on that, just based upon the S&P return for the last 18 years, that $1,000 would have grown to $5,080 that they would have had at the age of 18 as a result of that. So it's like a savings bond, I guess, in essence, where you're putting money into an account for a child and letting it grow untouched for 18 years. If you did the $5,000 each year, that could grow up to $214,685 at the end of 18 years. I don't know that these counts against the annual exclusion or count as gifts. I don't know if it's something separate. That's something I'll have to look into, but could be a nice way to start. Definitely nest egg for the first home purchase, or use for school, or a nice way to start a business when you get out of college. So this is an interesting provision. Alan, Peter, anybody, any thoughts on anything so far?
Now let's hope that one passes so we get to study it and use it. That'll be great.
Yeah, so moving forward here, number 19, 168K bonus depreciation. That has started to phase out here in recent years. I think it's down to maybe 60 or 80%. I'm not sure what the exact percentage is, but now it's back up to 100% if this bill passes. It applies to property acquired and placed in service after January 19th of this year and before 2030. So it does sunset, but it also doesn't phase down like it did under the 2017 bill. It stays at 100% for those 5 years. So that's an unlimited deduction. Go ahead, Alan.
So does that mean that clients who spend 500 hours acquiring a big boat or an expensive airplane for commercial use only not for any personal use, get 100% deduction for the cost of the boat or the airplane, and may convert it to personal use and pay rent to use it in a later year. Is that correct?
That's absolutely correct. Yep. Yep. And we have some good papers on that as well, if anyone is interested in that type of planning. You can still do that today. It's just the depreciation or the deduction is not quite 100%. So you might want to wait and see what happens here before you move on any big purchase if you are considering that type of purchase moving forward. Research and development expenditures back into play. So 25 through 2030, you can fully deduct and not required to capitalized R&D expenditures as long as they're in the United States. So there's some limitations there, but could be some pretty big write-offs for a lot of businesses that are in the development and research industries. Number 10, the business interest expense limitation. This gets a little bit worse under this proposal. Right now, the limitation, it only applies if you have gross receipts in excess of 25 million. So we're talking about, big business here that this applies to, not your everyday mom and pop shop. But if you are subject to this right now, it's based upon 30% of your adjusted taxable income. That allows you to take off depreciation, amortization as well before you apply that 30% limitation. Under this proposal, that 30% is going to be based upon your EBITDA. So a much higher threshold and much higher loss of interest expense is going to apply if this comes into effect. So this is a revenue raiser, not a taxpayer benefit here under 21.
And this one is going to bankrupt a number of private equity endeavors because private equity puts a lot of debt on a business, usually has more than 25 million of revenue. And then they've been floating this debt at 2 or 3%. Now it's up to 6, 7%. And now here comes this law, boom, bang, maybe get out of these deals or understand that these deals have a lot of risk at this point because of this proposal. This includes a lot of medical businesses, especially physician practices that are reliant upon Medicare HMO business, because the government is tough right now on Medicare HMO receipts, what you can bill for, how much you can get paid, and then you get hit on the other end with not being able to deduct your interest. So here comes the bankruptcy lawyers to a lot of American businesses because of this Section 21, and we've seen it, and it's a sad one. When you have a legitimate business deduction, a legitimate business expense for interest and can't deduct it. Go ahead.
Yep. And that EBIT, they call this the EBITDA limitation. So 30% of your EBITDA, which is your earnings before interest, taxes, depreciation, and amortization, that applied for the first 2 years of this under the 2017 Act, but then phased out. So then it was just 30% of your EBIT. Well, now they're bringing back in the DA. So could be, as Alan mentioned, a negative, a lot of negative impact there. Number 22 is similar to the 168K bonus depreciation, but that bonus depreciation does not apply to real property. Under this new proposal, you could elect to expense 100% of qualified production property. So if you build a plant, or let's call it a widget factory in the United States, and that's a production activity, which is manufacturing or refining or producing some sort of product, you can write off 100% of the cost of that factory in 1 year. So obviously you create a large loss that you can use to offset other income, carry forward if it's unused, as long as it's built in the United States. So again, part of this policy of trying to get manufacturing and producing back in the US, allowing write-offs for the cost of that if you do it if this proposal passes.
Wow, that's powerful. So you'll be able to sell any asset at a capital gain and then just reinvest the capital gain amount, not the entire sale amount, but the capital gain amount in a business that is in a qualified opportunity zone, which would include a single family home that you're going to be renting as an active business, and defer the gain. And not only defer the gain, But when you sell this at a profit more than 10 years later, there's no tax on that either. And a lot of these qualified opportunity zones were supposed to be in low income areas, but because the identification of the zones goes to historical records, some of them are in up and coming places. So this is going to change real estate values. It's going to change the way that clients think about what they should do with their capital gains. And these rules are delightfully complicated. So they'll need us or other people to help them interpret them. Thank you for complexity, Capitol Hill.
Yep. So yeah, QOZs, qualified opportunity zones, back into play if this proposal passes. And I think it also extend, under a lot of those investments, the recognition of it would be in 2026. Now let's kick back to 2020 or 2033. So another 8 years of deferral for a lot of those investments that are already existing. And they did change the rules on the identification of qualified opportunity zones. So I don't know if we'll have as favorable as zones as we did under the old rules. But we'll see what happens here. And we have some more slides on this and later in the presentation if you want to get and peruse those in more detail. Number 24, increase to the Section 199A deduction by 500,000 to 2.5 million can be written off under Section 179. And the phase out is also increased to 4 million of property. So if you acquire under 4 million of property, you can deduct up to $2.5 million under Section 179. If you acquire more than 4 million, that 2.5 starts to come down. But huge, 179 deduction still available and extended through this tax bill if it passes. Number 25, I was trying to find a picture here of Alan nice and sunburnt because the excise tax on indoor tanning services is being eliminated. So you might see some rates drop for your tanning beds, which was trying to find a funny picture of Alan, couldn't quite locate one. So excuse my notes there. Number 26, the clean vehicle credits, your energy efficiency improvements, your residential energy property expenditures, those are, and a lot of the other green energy tax incentives are going to go away if this bill passes. They're using that to pay for some other items that are higher on their agenda list. 28 is pretty similar, right? The purchase of solar energy equipment, that income tax credit is also set to expire at the end of this year if this bill passes. So if you are considering solar panels or some other type of maybe geothermal energy in your home and you want to get your tax credits for that, do it now. If this bill passes, you may not have the ability to do that in the future.
Or the purchase of a Tesla.
Correct. Yeah, other electronic, or not electronic, but electric vehicles, right? If you're considering that purchase, go ahead and get it done so you can get your tax credit because it may not apply moving forward. 29, interesting one here is a proposal that will eliminate your ability to deduct goodwill and other Section 197 intangibles for us tax nerds, but essentially we're talking about goodwill if the purchase relates to a franchise that's a sports team. So if you buy a baseball team or a football team, and there's obviously a lot of goodwill associated with those types of brands, then you cannot deduct or depreciate those items under the traditional depreciation allowances. Number 30, the SALT tax, state and local tax deduction limitation, still in effect. They are proposing to increase that to 30,000 from 10,000, but subject to a phase out if your income exceeds 400,000. So I'm just trying to think through this. If you're subject to this limitation, your income is probably going to exceed 400,000. So I'm not even sure why they're increasing it. So I can see the gripe for that. Some of these, it's almost seems like an artificial increase. It can't drop below 10,000, but that increase to 30 does phase out as your income exceeds 400,000. 31, they are targeting basically large endowments for private colleges and universities by applying a tiered excise tax system based upon your level of your endowment per student. And if my memory serves correctly, for example, if your endowment exceeds 2 million per student, then your excise tax is pretty much the same as we pay as not, as for-profit entities. It's 21%. So traditionally, these endowments have grown tax-free, or maybe a small excess tax of what, like 1.4%. That may not apply moving forward any longer if those endowments exceed a certain dollar amount on a per student basis. So maybe this will encourage universities, private colleges to offer more scholarships, make themselves more available for low income taxpayers, invest in the school and in infrastructure versus holding money in an endowment, I think is the policy, behind those types of provision. Same thing applies for.
And they'll be buying more growth stocks that don't pay dividends or pay tiny dividends, maybe municipal bonds. It will be interesting to see if this passes.
And private foundations are going to be subject to the same type of tiered rate structure as well. If the amount of your investment income in the private foundation exceeds a certain threshold, the excise tax is increasing based upon a tiered structure. If this proposal passes. 33, if you make your donations to charity from a corporation, it's now subject, or will be, if this proposal passes, to a 1% floor. So for example, if your corporation's income is $1 million and you make a donation from that of $10,000, then that is your floor. So only donations over 10,000 will count, and it's capped at 10%. So you might be better off making it personally than you would through the corporation, because it's not as large of a cap. The AGI limitation is higher personally, and you do not have a floor personally if you are itemizing deductions.
So do you mean the first 1% is not deductible?
Correct.
Okay. So you may want to
on your income.
So instead of gifting 4% a year, you would gift 8% every other year to get around half of that.
Yeah.
Okay. Boy.
All right, so that wraps through what I thought were the highlights. Alan, you want to talk a little bit more about the estate tax proposal and what our thinking is as far as advising clients there?
Yeah, I think I'll leave the estate tax for last. We can come back to these slides if you want to hit the highlights here. We've got about 28 minutes left. So if you want to, by the way, there's just a lot of great slides here. We've put the slides in the chat. We're going to be retransmitting this video in about, I think, 3 or 4 hours. And when you get it, if you want to forward it to people, they can set it on a higher speed so that we sound like this and go faster. And also they can set it to the highest resolution so that our picture will look better as far as those beauty tips. But what Landon has done, and Landon's done a great job with this. And let me just say that one thing I learned a long time ago is that you can hire law students or you can hire undergraduate students, and you hire an undergraduate student and you put that undergraduate student with the law students, and that undergraduate student may just outperform the law students before that undergraduate student goes to law school. And that's the story of Landon. So Landon's put the 2017 and 2018 rules here in blue, because this is what happened when this act was passed. And then in purple, we have the proposal for 2026. So you can see what's changed and how it's changed. What slides is Landon going to cover?
Yeah, I think those are coming right up after we get through these. These are obviously just our tax brackets, and I was off by a couple thousand there on the highest rate for married filing jointly. It's $767,000, so it's moving up there. We were back at 470 in 2017, and now we're almost double that. So
Landon, that's just a little bit less than what your first year salary will be after you graduate from Emory Law School and go to work for a big law firm. That's assuming you work all 5 days a week, by the way.
So I think Peter might be up first here with if we want to talk a little bit more about qualified business income and what the changes are there under Section 199A.
Sure. So I think to kind of understand the changes, it's good to review what the 199A, the rules for the 199A deduction. if you remember, prior to the TCJA, the corporate tax rate was 35%, and they reduced in that 2017 act the corporate tax rate down to 21%. And so they didn't want to cause changes in taxpayer behavior by making everybody switch any pass-through entity over to a corporation. So they gave this deduction for qualified business income to try to help make pass-through entities on even footing with corporations who got that tax decrease. So the 198A deduction is 20% deduction on your share of qualified business income from qualifying trader businesses. It's subject to a few different limitations, and the limitations are what have been amended here. So the first thing I'll mention that's been amended, and this would be made permanent. The second thing is that it would increase the percentage. Instead of being a 20% deduction, it would be a 23% deduction. And now I'll get to the limitations as it exists now. So the first limitation is that it's limited to 20% of your taxable income minus your net capital gain. So it only applies to that amount, and you're limited in the deduction to that amount. Then there was two important limitations that applied to what the 198A calls high income taxpayers. So there was certain thresholds depending on whether you're married or single. And if you had income over that amount, two additional limitations applied to you. The first limitation, this is very sad if you're a lawyer or an accountant or an NFL player or in some kind of service business, is if your income came from some service business like that, you did not qualify for the deduction. The second limitation was that the deduction was limited to the greater of 50% of your business's W-2 wages, or there was another calculation which would be 25% of your W-2 wages plus 2.5% of the basis in certain qualified property. So there, now I'll talk about what the changes are, and it's good news if you are an attorney or an NFL player or an accountant, because you're not going to be able to get the full deduction, but there is a way that you could benefit at least from a percentage of it. So you're going to see here, we already talked about the first and second modification, but here the third modification, it creates a two-step process. So the first step is that it is going to, the limitation, we have that same limitation that I said, if you are a high income taxpayer, that it would be the greater of 50% of W-2 wages or the other calculation. And I think, actually, I think the best way to show this is to go to the next slide. I'll give you an example. All right, so here we have an example of somebody like an attorney or an accountant or somebody who has a lot of qualified service trader business income, which previously they could not deduct. So this taxpayer has taxable income of $483,900, which is $100,000 more than the threshold previously of $383,900, which is a inflation adjusted number. And that same taxpayer has $700,000 of service trader business income, which previously he could not get the QBI deduction. So first we look at this the way that we would before, and we'd say, well, under the previous rules, there's no deduction because he has no qualified business income. The only income he has is from a trader business is this as a service trader business, which doesn't count. But now we go to this step 2. And here we're going to look, we're going to take his $700,000 of qualified business income, multiply that by the 23%. It says 22. I took this from a previous version on accident and it was increased to 23. But now it'd be 23% of that. And then we're going to subtract 75% of the difference between his taxable income minus the threshold amount. So it's $100,000 that he was over the threshold. And I know this is as clear as mud maybe, but The point being is after you do this new calculation, this attorney or NFL player or accountant who previously wouldn't have been able to qualify for the QBI deduction now would get a $79,000 deduction. That's kind of the moral of the story here. If we go to the next slide, two other modifications to this. They now include in the calculation of REIT dividends, qualified business development, company interest dividends. We kind of give more information about the definition of that there. And then lastly, it continues to index the threshold amounts for inflation. Big points being, in summary, it's increasing from 20 to 23%. And there is a way now, if your income comes from a service trader business, that you will be able to get a deduction under 199A.
And the more the income, the more the deduction. It's almost like a new threshold. It sounds like the threshold's about 580,000 and you just get the full deduction on everything above that is the way it's, or you get what, 23% of the rate of the deduction above that? We'll come up with this. This is one of these things where you say, do I want to understand all this and spend another 3 hours, or do I wait and see if it even passes? Well, this one's worth understanding because it's going to be a big number for clients in the service industry. Okay.
I think that's the last slide on this.
Right.
Yeah, I mean, I think just one thing to mention here, we did a lot of slides on planning for Section 199A, and, some of these are probably still relevant because you could get kicked into not even having to worry about Test 1 and Test 2 because your income doesn't exceed a threshold amount by allocating, portions of income to low-income taxpayers. And one of the ways to do that is using the 678 trust, where the beneficiary of the trust is deemed to own the trust. And therefore, if it's a child that has low income, you can spray a lot of income that would otherwise be subject to some of these threshold limitations under 199A, and have a nice write-off with this deduction. So based upon the prior rules, we could save right around 7% of the income that we could allocate over to some sort of non-specified service trader business or non-threshold taxpayer. And so we'll see where this ends up, and if this type of planning still works or still helps in a way when we get a final proposal, but something to keep in the back of our minds. So Landon, I'll kick it over to you. Let's talk us through how this no tax on tips is going to work.
Sure. So like Brandon said earlier, this is part of the proposal that a lot of people have their eyes on, since this was one of Trump's campaign promises. So what they're proposing here is an income tax deduction equal to the amount of qualified tips that one receives in a taxable year. And what they mean by qualified tips is something that's voluntarily paid by the person giving the tip. Also, one of the stipulations is that it has to be in a profession that traditionally receives tips. So unfortunately, Alan, I don't know how well it would go over if we started asking for tips on the invoices from the firm or anything like that. I don't know if the Treasury would like that very much. And also, this tax on tips proposal would not include anyone who is a highly compensated employee, which for the year 2025, I believe it's $160,000 in income for a year for highly compensated employees. So the tax on tips would not apply to that. And Brandon, like you said earlier, with the standard exemption rising this year, a lot more people may be doing that. And something interesting about this is that the tips deduction can be used in addition to the standard exemption. And so this is being proposed to begin in 2025 and sunset in 2028. If you'll move to the next slide. And then similarly, something that a lot of people have their eyes on, no tax on overtime, which is an income tax deduction equal to the amount of qualified overtime compensation that one receives during a taxable year, which is the overtime required under Section 7 of the Fair Labor Standards Act in excess of the standard rate paid to the employee. This similarly would begin in 2025 and sunset in 2028. And something excluded here is qualified tips from the previous part of the proposal. So unfortunately, you won't be able to double deduct tips that you earn during overtime. And it also would exclude individuals who are highly compensated employees during the taxable year, those making 160,000 or more.
That's great. So first of all, let's mention this does not exclude any of this money from FICA, FUTA, right? So they're still going to pay 7% by the employee, 7% by the employer. Or if it's an independent contractor, they're still going to pay, and that's for the tips. They're still going to pay 14% employment tax, and maybe that's why this is deemed to be fair, because they're already paying so much employment taxes. But secondly, is on the overtime. If I work an extra five hours and I make an extra, and I make my normal wage would be 100, but I make 150. Is the whole 150 tax free, or is it just the 50? And if you don't know the answer, make one up.
From what I saw in there, I don't know if Brandon or Peter, if you took a look at this and have a different answer, but it's my understanding that the 150 would be excluded from income tax under this proposal.
And are there any studies that show what percentage of tips are actually reported on tax returns?
For cash tips, I would assume not a lot. So
Yeah.
that if it raises a few eyebrows, we'll start reporting.
I think that's another way they're trying to, maybe do this too, is to help people start reporting tips. Because if you don't report your tips, then you don't get the deduction for it. And then you're not taking out FICA, withholding as well.
No, yeah, you're reducing your Social Security benefits. That
Right.
reporting the tips may be the best investment you could make. So let me ask you this: if strippers and prostitutes normally get tipped, but sometimes lawyers are called prostitutes. So is there any way that would get us we could get that done?
We can pick that up. Yeah, we can start a case.
Please.
Yeah, it says the Treasury is supposed to publish a list. So I think we're going to have to lobby the Treasury, to get attorneys and accountants, on that list.
Absolutely. We are the second oldest profession, I heard.
Exactly.
Okay.
One other thing to mention here, I don't know if I included it in the slides, kind of, tip related, is the FICA tip tax credit that food and beverage industries receive, where you get to, basically you get a credit for your half of FICA taxes, still is going to continue to apply and is made permanent. And they've also now added beauty services, who will also now receive that benefit moving forward if this passes, which is, your spas, nail salons, barbershops, those types of services. Okay, so a little bit more here on the MAGA accounts. I touched base on this earlier, but to recap, we're talking about a trust that's created for an individual under the age of 8 at the time of the creation. Has to have a qualified trustee, which is a bank or some other person designated basically under Treasury regulations that the Treasury feels will abide by these rules. So I don't know who's going to qualify for that. Maybe parents, maybe they'll have specific, maybe it, be required to be certain types of professions. We'll see where that comes, but banks certainly qualify. Your annual contributions are capped at $5,000 per beneficiary. That's adjusted for inflation, so you can add more, in future tax years. They have to be in cash. We're not talking about putting in securities in kind. That's not going to work. It's got to be cash contributions, and the investments have to be in specified things. They have to be tracked by U.S. index. They have to avoid leverage. You can't margin these accounts, and it has to pay minimum fees. So we're talking basically S&P 500 index funds or Russell 2000 index funds. You're not allowed to touch this account before you turn age 18. Once you turn age 18 through 25, you're limited to basically 50% of the account's value at age 18, so you can distribute up to half of it. And then at age 25, you can distribute all of it for qualified items. And if you do that, it's capital gains on your gain on what's occurred under that account. If you distribute for something else, if you say, here's $20,000 to go to the Bahamas for the weekend, that's going to be ordinary income at a 10% excise tax if you're under the age of 30. And then at age 31, everything comes out of this account and is distributed to the beneficiary, taxed at their income rate, at capital gains rates. So we'll see where this goes, but it's a nice little thing. And then the interesting part of this is every child born between this year and the end of 2029 or into 2028 is going to get $1,000 in an account for them that can grow tax-free until they reach the age of 18. As I mentioned earlier, that could be, $5,000, $6,000 by the time they get the age 18 that they can use towards a lot of different things. Qualified residents we're talking about. Peter, you want to talk us through a little bit more on the bonus depreciation?
Sure. So there's two provisions, Brandon talked about them briefly at the beginning, that now allow you to write off all or a portion of the cost of a capitalized asset for a business. One is section 168K, which we usually call bonus depreciation. The other is section 179. And so there are amendments to both of those in this act. So 168K bonus depreciation, in the TCJA in 2017, it provided, Brandon mentioned this earlier, a phase out of the percentage of property that you placed into service that you could use this bonus depreciation and depreciate in the year of acquisition. So it started at 100% in 2022, 2025, it's 40%, it's set to go to 20% in 2026, and then down to 0 in 2027. So the proposal here is that it would increase the allowance back to the 100% that we had in 2022 for any property acquired and placed into service after January 19th, 2025, up through the end of 2029. So it's sort of like what we had in 2022, continuing for that period of time. If you'll go to the next slide, please. Unless anybody had any comments on that. We have a slide here, 42, if you want to come back and look at what the property has to be, that has not changed. So
yeah, basically under this, sorry, Peter's jumping. Yep. We're talking about anything non-real estate basically is qualified. Right. 20 years or less is the period. Mostly real estate's above that. Most other things are below that. Equipment is one that qualifies. Vehicles, another one that qualifies. Computers, stuff of that nature, you can fully depreciate.
Yes, thank you. Then 179 is another way you can expense something in the year of acquisition. But if the property qualifies, you're limited to 2.5. There are limitations now. They've increased those to $2.5 million, and then there's a phase out at $4 million. This is the same rule. They've just increased the numbers. And Brandon mentioned this briefly before, but for every dollar that you have above the 4 million, that's going to increase by the same amount, that 2.5 million amount. So
yeah.
Same rule.
Just one other thing to add there, the interesting thing about bonus depreciation coming back in is you can create a loss with bonus depreciation, which you cannot under section 179. So when we were losing bonus depreciation, a lot of these losses that we were able to create with expensing items in 1 year, was going to be lost because we just have to rely on 179, which we could only use to the extent of gain or, our income. So coming back with bonus depreciation is going to be a huge gain for taxpayers if this does pass.
And there's a question here. There's a question here.
Yeah.
It says, if I divorce my husband and buy a boat for business purposes and marry a captain who is also a stripper, can I have my company pay the tips and get a deduction, but not have to put it on my joint return? Does that make it section 179 or a 1?
Yeah, there's a 168K. You could take the boat and write it all off, and then you'd have your deduction for tips, and you'd probably have an indefinite carry forward loss that you could use for many years.
All right, so that's an important part of marital planning then now under the tax act.
My question would be is if you could still deduct your tips, because if you can afford a boat, you might be earning a lot of tips. You might be outside the thresholds.
Yeah.
Might be a highly compensated stripper. I don't know.
Yeah, right. So if we only have 1 minute or so left, so I can cover estate taxes,
Yeah.
what you want to make sure that we cover.
Yeah, no, I think I would go that. The rest of the slides here, there's more info on this scholarship granting organization. I think that one important thing there, private foundations don't qualify for this, so it's got to be like a public charity that does this. And there's rules against self-dealing, so you can't make sure that the money you give is directed towards your child or other favored individual. It's got to be to the general public at large.
Yeah, most of our charitable clients don't like their children anyway, so that fits well. So, Peter and Landon, I know, and Brandon, I know you guys may have other stuff to do. So if you feel like you need to leave, that's no problem. I'm sure most of the attendees would like to leave as well, but they need to.
I am gonna pop out. I got swimming lessons coming up with the kids, so I'm gonna head out of here. But
I thought you knew how to swim.
I do. They're struggling with it. So we'll get them on it. All right.
All right. Thanks a lot.
Good afternoon, everybody. Yeah.
Great job. Any mistakes in the slides? Those were Brandon's. So
That would be true. Yeah.
So I'm going to talk a little bit about the estate tax, and I want to mention if you go to estateview.info, we have a video library that talks about a lot of the planning techniques. And also Peter, who just left, gives 3 live workshops every week. They're extremely lively, and he tells jokes and sings and dances as well. You don't have to tip him. But then he'll show you how to use the Estate View software, and you can get a free trial on Estate View. Just go into estateview.link and go in as a new subscriber. And instead of paying money, use the code free trial, FREETRIAL, and then you'll have 10 days to try out Estate View. So go into the estate tax. Where are we? A lot of your clients, a lot of our friends are going to be lured into not worrying about the estate tax, and then they're going to end up paying the estate tax. When I graduated law school in 1984, the amount that could pass estate tax free was only $325,000, and once you hit 2 million of assets passing, the estate tax was at 55%. And everyone thought it was such a big deal when they moved that up to $600,000. So it can come back down. In fact, you see the rates here, what they've been historically. Now, they've always gone up. They've never come back down. And then after 2018, that's when they doubled. And January 1st, 2026, they're supposed to go back down to 1/2 of that. Landon, what do you think the chances are that it'll go down to half in 2026 and that President Trump and the House and the Senate will not extend the exemption?
I wouldn't bet on it. I would not.
Right. I don't think it's going to go down. Now, if you were lucky enough to live if you were lucky enough to die in 2010, or let's say your family was lucky enough to lose you in 2010, there was no estate tax because Capitol Hill couldn't get its act together. So we could have a few days in 2026 where, oops, if you die, you're at half of the exemption. I don't think so, but Trump's approval rating is going down fast, and I'm not implying that that's good or bad, but you could conceivably have the estate tax exemption go down. If not, then in 2029 you're going to have a new president if they follow the Constitution, and that new president may be a Democrat, and you could have a Democratic House and Senate, and then that exemption could come down to $3,500,000. Now, the estate tax is not a big amount of revenue for the U.S. government. Maybe it's more of a public image situation, but reducing the exemption to half would put an extra $167 billion on the table. Isn't that interesting? That's about the net worth of Elon Musk. So it's only one Elon Musk, that difference that it makes. But the perception of the public is a billionaire family with 100 billion, let's cut them back to 50 billion. That's not a bad day's work. Or let them donate most of the 100 billion to charity, and their children can control that. Now, the other thing going on, because a lot of us do large loans to trust for descendants, is that the interest rates are up. The applicable federal rate for a lot of you, I'm looking at the names of the people on this webinar, and I know you've been watching us for 2 to 3, 4 years back when the rates were 1% and 2%. Now the long-term applicable federal rate is 4.57%, and with that Moody's downgrade, since these rates are based on T-bill rates, I think these rates may go up. So now would be, if you're telling me I'm not going to do an installment sale because I think the rates are too high. I remember when the applicable federal rate was over 8% and we were still doing installment sales. So maybe give that a chance. Well, let me go ahead and pull up Estate View. And do you see it there?
Yes.
Yeah, okay, good. You see my Google. So I'm going to go to Estate View, ESTA view.link. And Estate View opens up. I'm going to be a subscriber. It tells me go. And now what I'm going to do is I'm going to click on Instant Plan. And like I said, we'll be sending this video out so you can just follow what I do. And then with Instant Plan, I'm going to click on Calculator Only because I don't want all the information on this family. I just want to run some numbers for them on the estate tax system. And then I'm going to click on Get Started. This brings me to the form that I can fill out. And I can just fill out this form, and my calculators only need the yellow information. So that's the name, male, female, so we can tell you about life expectancy. Are you married or not, regardless of whether you want to be? And then what about that for your spouse? What about your children? And then some key financial data. So I'm going to, as opposed to having you watch me fill all this out, I can go to one that I recently filled out for Jordan and Bassie Fish. So I'm going to open their data, and Jordan, and by the way, I'm talking about the $15 million exemption here. So do they need to worry about it? So Jordan is a retired physician. He is male. He was born in 1954, making him older than Landon. And he is married to Bassie, get it, Bass Fish, anyway. She's female, born in 1972, 28.8 year life expectancy to age 82. And Landon, what do you want to bet that medical science is going to advance significantly and she'll live to 92? I expect that you will live at least to 100.
We can only hope.
You can only hope, exactly. So, and I was told yesterday that once you reach like 92, your body doesn't age anymore. It's just a matter of when something comes to get you. Okay, so then they have a child named Bernard, and so they have one person that they can give $38,000 a year to, and then they are saving $250,000 a year because he's still working. And when he reaches 75, he's going to slow down and only save $100,000 a year. And then when he reaches 80, he's going to spend $300,000 a year. And if he dies, she's going to do the same thing. She works, so she's going to save $250 a year if he dies until age 70, and then she's going to start spending $300,000 a year. She's going to buy a boat and have a captain, is what's going to happen. She's going to have a lot of tip money. And so then they have $1,250,000 house growing at 4.75%. He's got $1.5 million in his IRA, 80% in stocks. He's very bullish on stocks, and he does stuff even on margin, and his average rate of return over the last 20 years has been like 14%. It scares me how aggressive he is, but he's done well. So he's got $1.5 million in his IRA. She's got $1.7 million in her IRA, and they've got 12 million of other investments. So what's that? About 15 million just between the two of them. Plus, I said about 1 million homes, so they're at about a $17 million net worth. And then they've got the medical practice that he still owns. He's not practicing anymore, and it's worth $1 million. And when he sells it in 10 or 20 years, because she runs it also, it'll get $1 million. They'll pay a tax of 250,000. Now, this is an important feature because if they had a $5 million business that was going to grow to 100 million, we could put that in there. So this family, I wouldn't think that they would need to worry about federal estate tax so much. And I'm going to click on results here, RESULTS. Oh, before that, let's go through some assumptions. So I'm going to click on assumptions, and I'm going to use the IRS life expectancy, which is low, and an estate tax rate of 40%, inflation rate of 3.71%. And I'm going to say that the exemption will drop by 50% in 2026 when I first show this to you, simply because it could drop in 2029, and maybe the prudent planning is to think it will. But if they're optimistic that it won't, maybe it's not a concern. And I won't have to show you a qualified personal residence trust. I'll show you what we call a bypass trust, annual gifting, discounted annual gifting, and a large gift. So I'll hit on results, and now I'll go to what we call married comprehensive. And what I have here is, yeah, they've got $17 million net worth. And if they die this year, if the exemption goes down and they die in 1 year, there's a tiny estate tax, nothing to worry about. If they die next year with some planning, no estate tax. But let's go to no planning. Year 14, he dies. Year 38, she dies. Growth at, I think I put in 8%. The estate will only be $153 million. So that's a pretty big bite. I'm sorry, the estate tax, 153 million. The estate, 384 million. I think they'll be slightly over the 30 million threshold. And then with a credit shelter trust on the first death, which benefits her but is not subject to estate tax on her death, that brings the estate tax down to 124 million. Then annual gifting, 19,000 or 38,000 a year to their son. That causes $11 million over 38 years to be out of the estate tax system. Discounted gifting of LLC interest brings us to 16 million in the gift trust. Now we got the estate tax down to 118 million. This is nuts, isn't it? 1/3 of their investments gifted now. He could gift 1/3 of their investments, not the IRA, but 1/3 of the 12 million. That's 4 million. He puts it in a trust, gifts the 99, an LLC gifts the 99% LLC interest at a discount. Now the gift trust starts at about 3,960,000. Still an estate tax of 85 million, even if he starts today with that. So what if he puts $1 million a year into what we call a rolling grat? That'll help a little bit. But then we go to the installment sale, and people say, well, you could put 67% of his investments, so that's 8 million, into an LLC, and then sell that LLC 99% LLC interest at a 30% discount for a note of about 5.6 million. So what you see here now, his investments are only 2.6 million. What does this family have? 2.6 million of investments, a home of 1.2 million, a gifting trust that got the LLC with 1/3 of his 12 million investments. It's got 3.9 million in it. $1 million that he put into a rolling grat situation. And then finally, an installment sale where he has put about $8 million into an LLC. He's made a $6 million seed capital gift, and he sold the 99% LLC interest to the trust in exchange for a $5.6 million note bearing interest at about 4.7%. In 14 years, that installment sale trust has 15 million in it. It's got a 15 million net worth, even though we only made a tiny gift. And the bypass trust gets 7 million, and she has 15 million of investments. But fortunately, she's gonna, we're gonna have, while he's alive, they've been paying the income tax on the installment sale trust and the gift trust. Now he dies, another 38 years goes by, and that installment sale trust has $119 million in it. There's still a $31 million estate tax. And the people say, can this be true? I mean, could my assets really grow that fast? And I can go up here and I can show them something else, Lynn. And can you explain what a Monte Carlo analysis is? Or do you want me to?
I think you understand it better than me. I think they gain more from you explaining it. I know you say to make up answers, but
Okay, so you put $12 million in an investment portfolio, and you roll the dice 40,000 times, because the first year, and you base it on what the rates of return of the S&P 500 have been for since 1936. And the average rate of return is 10.85%. But if you're in the top quartile, 25% or less of the investors would make 13.3%. 10% or less would make 15%. I only showed those numbers at 8%. If I go back, once the client has seen this and says, wow, this could grow at, I mean, there's a good chance this could grow at 13.3%. So I can go back to key financial data, and I can go ahead and put in here 13.3%. So let's see, rate of return, 13.3. There we go. I'll go 13.25. Back hit results again. Go back to married comprehensive. Now on the second death, $718 million. That's pretty impressive. Now there's a lot of other things I can do, which I'll go to later, but for now, I'm going to save these results to our calculator, click save, and I'm going to go home. Now, Landon, you're already at home, but I'm at the office, but we go home. And then I'm going to click on married clients. This is a boat owner and her husband. And I'm going to show the bypass trust annual gifting, discounted annual gifting, a large gift, a rolling grat, an installment sale, and testamentary to charity. And I'm going to provide that the exemption does not go to half, so they don't have that much to worry about. But with this high rate of return that I've mentioned, let's see if it carried over the high rate of return. Yep, there's my $1 million medical practice. There's my 15 million growing at 13.25%. With the credit shelter trust, tax on the second death, 543 million. So they could do annual gifting. That'll get 34 million in the gift trust at that rate of return. Discounted annual gifting, 49 million in the gift trust. A large gift puts 497 million in the gift trust. They're still at $366 million. Now Now they may think that's enough, and they'll contact me when they get over the exemption. When will that be? I click on the timeline, and they'll start having to pay estate tax in 2031, and it's going to be a really big chunk in 2055. So yeah, they don't have that much to worry about yet, but at what point are they going to try to catch this? So there's with the rolling grats. You see the rolling grats in yellow. You still see, a pretty big threat to their wealth. And then you go to the installment sale. Click on installment sale. And that is the installment sale trust. And that is how small that gift tax is. So I guess the question is, when you look at it this way, that installment sale gets the tax down to $96 million. Now, if the estate tax, and by the way, I need to move up my gift there. If the estate tax exemption was going to go to half in 2026, then their estate tax exposure would begin earlier if they don't do the installment sale. If these folks don't do the large gift, you see a significant estate tax beginning pretty soon. So, this is a couple with a net worth under $5 million. But I think a lot of people will say this is an unrealistically high rate of return. Well, I just showed you by 40,000 rolls of the dice, there's a 25% chance that that'll be their rate of return. But I could take it down again, find my investments, and I could take that rate of return down. When I take the rate of return down inside the trust, and then also let's see where that was, business and investments. Yep. Then you see a lower tax problem, but more of the same issue. So that's why I think you've got to run these numbers in order to show the client what's going on. And now I just want to show off estate view a little bit because I can. And I'm going to go back home, and I'm going to go to Instant Plan to show everybody what you can do with it. You go to full intake form, and then you click on Get Started. And now under full intake form, you can fill in as much or as little as you want. It is not one of those darn programs that when you click on next page, it says, no, there's an asterisk there. We still need to know your dog's middle name, or you can't go to the next page. We don't have that. So I do have also a sample. So I'll put in my sample inputs, and now I've got an individual with a lot of information. In fact, I can click on Review Summary and show you that now I'm dealing with a 60-year-old named Bob, male, married to Mary, female, and they have a bunch of kids and a bunch of grandchildren and a lot of assets, et cetera, et cetera. And ask not what you can do for Estate View, ask what Estate View can do for you. I click on results, it runs 40,000 programs. And I'm going to say the coolest thing for our law firm with Estate View is that it does immediately tell us what the estate tax plan may look like without having to go to the calculator I just took you to. So this shows what all these techniques used in conjunction can do for the client. But what's very nice, and of course a lot of people have clients that are not subject to estate tax, I can click on Generate Planning Chart, and then I can say, do I want to show these people their assets without a trust, or with a joint trust, or with separate revocable trusts? How will that look? I'll click on Separate Revocable Trusts, and then it just made an Excel spreadsheet, and I can click on the Excel spreadsheet. There it is on my second screen. And it's taken all that data that's been entered into the computer by the client or by our law firm, and it's put it into one page. So you can see what's really nice, Landon, when you do an estate plan is when the clients walk in the door, if you have this in front of them, they can say, wow, I never realized I had all these assets, and this is, wow, these are under companies. Oh, these are owned by me. Oh, these are owned by her. Oh, these are jointly owned. Oh, here's our IRA. Oh, here's what they add up to. It's really nice to have that. And then also it immediately tells them what their IRA growth and payout will be with and without charitable planning with their IRA for both spouses, gives me the names of all their key people, and also points out important planning parameters that come to mind according to our computer, not AI, all analytically programmed, and a family tree. So I can see who's the parents, who's the grandparents, who's the children, who's the grandchildren, who's the great-grandchildren, and that's really valuable. So anyone who has a state view can certainly do that and enjoy it. And then I can also click on another Excel document. Thanks very much to Mason, the programmer, right out of college, for putting these spreadsheets together for me. It took weeks, not months. And now I have, and you want to see this too, Landon, you always want to be able to show the clients, here's what's in Bob's name, here's what's in Mary's name, here's what's joint, and here's your liabilities, and there's the net value for each asset class. I don't know about you, but I think we should move these asset class names to the right also, so that you can look on the right and the left and see what they are. Do you agree with that?
Yeah, I think that would be helpful.
I think we'll have Mason do that. But then also, I can also show them another thing that's important, and here's their assets by relative size. So this is pretty good. Their house is not a lot bigger than their investments, and their 401ks are bigger than their house. And that's a good thing. When your 401k is bigger than your house, you know you're doing well. So that's before they retire. That is after they retire. And then speaking of retirement, I can go and I can click on the retirement program, and it gives me a little start of a retirement program. They have 28, if they had 28 million of investments, because this is a different couple, and they want to retire on 2 million a year, can they do it based on the rate of return? No, they can't. So I can now go to my retirement module, and then I can go into there and I can experiment with what they need to increase and what they need to decrease in order to be able to retire. First, they should pay for their estate plan and see if they can retire after the large cost of the estate plan as well. And then this, when I click Pro, click there, it gives me a handy dandy chart and an Excel spreadsheet showing all of their assets and all of their expenditures. I can add more things to the spreadsheet and change the numbers. I can show college, et cetera, et cetera. And it also tells me how much life insurance they need if they die anytime soon. So that's the Nest feature. Any other features you want to see there? I think that's plenty for today. Looking forward to refining this outline, this PowerPoint deck that we just did together, Landon. We will be watching the House, watching the Senate, and watching eventually what gets signed. And we are ahead of the curve here. So Landon, thank you very much for working on this. I'm proud of that. I gave it to you, we started Wednesday afternoon?
Yeah.
And you pulled all these slides together on Wednesday night, Thursday, and yesterday, which was Friday. Brandon helped, Peter helped.
Yes,
I'm proud to say that I hardly helped. And I thought the presentation went pretty well. So we still have Another thing that's interesting is we still have about 65 to 70% of the attendees are still on, which shows that they weren't actually watching. They actually just recording this, or they are asleep. But thanks everyone for your following us. And you've got our email addresses here: agassman@gassmanpa.com, landon@gassmanpa.com. If you have any questions whatsoever, as always, send me the easy questions, send Landon the hard questions, and we'll get right back with you. Have a fantastic rest of your day. Thanks a lot.
Thank you.